Welcome to the Explainer. Today, we're completely peeling back the layers on Celsius Holdings' Q2 2026 earnings report that just dropped yesterday, August 5th. Look, if you follow the beverage space at all, you already know Celsius has been an absolute darling of the market for the last few years. But man, this quarter, they threw a massive curveball. So let's dive right into the data together and figure out exactly what went wrong, what went right, and what it all actually means for the stock.
Okay, here is our agenda for today. We're going to cover 1. The Q2 market shock, 2. A rare revenue miss, 3. The tale of three brands, 4. Management asks for patience, and finally, 5. The bull and bear cases.
Starting with Section 1, the Q2 market shock. A tough day for CELH. I mean, just look at the sheer scale of this market reaction. It's honestly staggering. Down 47% year to date. That is a massive haircut for a company that was pretty recently a Wall Street favorite. Right after the announcement, the stock absolutely plunged 18% in pre-market trading alone. It's now hovering near 16-month lows. You know, when a growth stock is priced for sheer perfection, any slight deviation from that trajectory results in a swift, brutal repricing. But why the sudden panic? Let's look at Section 2, a rare revenue miss. Wall Street expectations versus reality. So Wall Street sets the bar. And well, Celsius tripped over it. They missed adjusted earnings per share, which is essentially their core profit metric, bringing in 36 cents instead of the expected 43 cents. That's a 16% miss right off the bat. And on the revenue side, they fell short by nearly $70 million, bringing in about $818 million compared to the $886 million that analysts had modeled for. Now, obviously, context is everything here. Total revenue did actually grow 11% year over year. And hey, in a vacuum, double-digit growth is solid, right? But this was the company's first revenue miss in 5 consecutive quarters. Wall Street had gotten super comfortable with Celsius not just meeting expectations, but completely blowing past them. In our current macroeconomic environment, breaking a flawless streak like that, yeah, it has immediate and severe consequences for your valuation. Management did try to point out a silver lining amidst all this top-line chaos. They noted that gross margins held steady at about 48%. And sure, maintaining pricing power and production efficiency is fundamentally good business. But as you can clearly see from the stock price, that metric alone just wasn't enough to calm the broader investor concerns about slowing growth. Moving to Section 3, Tale of Three Brands, a portfolio performance breakdown. Just look at this massive divergence. On one hand, you have the booming, undeniable success of Alani Nu, rocketing up over 55% in year-over-year retail sales. But that completely contrasts with the notable declines of the flagship Celsius brand, which is down 11.7%, and Rockstar, down 13%. It is literally a tale of 3 completely different brand trajectories, all operating under one corporate roof. Let's actually zoom in on that 11.7% drop for the core Celsius brand, because that's really the engine of the company. Management attributed this decline to 3 specific things: higher promotional spending just to move product, inventory rebalancing from distributors, and softness in the club channel. That basically means bulk retailers like Costco and Sam's Club aren't moving pallets quite as fast as they used to. And that last point, absolutely crucial, because club channels are usually incredibly reliable volume drivers. Conversely, Alani Nu is an absolute powerhouse right now, delivering $364.4 million in revenue this quarter alone pretty much proves this is a legitimate billion-dollar brand in the making. It's clearly resonating with consumers, capturing incredible momentum, and honestly doing the heavy lifting to keep the overall portfolio's revenue in the green. Rounding out the trio, we've got Rockstar bringing in $66.5 million in revenue. This is a brand Celsius recently acquired, and based on that 13% decline in retail sales, it's pretty clear they're still trying to figure out the whole shebang when it comes to turning it around and integrating it into their winning ecosystem. It's definitely a work in progress, to say the least. But hey, when you step back and look at this entire portfolio combined, the scale is genuinely impressive. They hold a 20.1% market share. Think about what that actually means the next time you're at the grocery store. Roughly 1 in 5 energy drinks sold in America comes from this company. That is massive market penetration, which gives them some serious leverage with retailers. Next up, Section 4, Management asks for patience, navigating the transition. This direct quote from CEO John Fieldy really tells us exactly how management is thinking right now. He said, "With $2 billion brands and roughly 1 in 5 energy drinks sold in the United States coming from our portfolio, we are a key growth engine for the category, and we're still early in what this platform can do." Basically, they aren't panicking. They're emphasizing their massive scale and framing this current turbulence as just the early stages of a multi-brand platform transition. Feely also reminded investors of the macroeconomic headwinds they're quietly defeating behind the scenes. They're actively navigating commodity inflation, specifically with aluminum costs, which obviously hits canned beverages hard, yet they're still successfully maintaining those steady 48% margins we talked about earlier. Ultimately, management is just asking the market for patience, arguing that building a massive multi-brand platform simply takes time.
Finally, Section 5, Bull and Bear Cases. What this means for investors.
Evaluating these dual realities side by side reveals a pretty stark split. The bears? Well, they see a stalled flagship brand burdened by inventory issues and reliant on increased promotional spending just to move cans, all while the stock has basically been cut in half this year. But the bulls? They see an incredibly successful portfolio strategy. They see Alani Nu's torrid 56% growth picking up the slack, anchored by that dominant 20% overall market share in a highly lucrative industry. Both sides have completely valid points, backed up by the exact data we just reviewed. So this creates a fascinating shift in who actually wants to own the stock right now. With prices at 16-month lows, value investors, the folks looking for established companies trading at a discount, might finally be seeing a solid entry point. Meanwhile, growth investors who live and die by flawless, rapid top-line momentum are probably staying far, far away now that the core brand's growth has visibly stalled.
Over the next few critical quarters, management is going to be under a microscope. They're going to have to prove they can execute on 3 distinct steps to win back Wall Street's confidence. First, they've absolutely got to stabilize the flagship Celsius brand and fix that club channel softness. Second, they need to continue feeding Alani Nu's incredible growth without cannibalizing their own sales. And third, they have to actually execute that Rockstar integration and turn that negative 13% around.
So, I'll leave you with this final thought to ponder as you digest all the data we just explored today. Is this Q2 earnings report just a temporary speed bump for a growing, multi-brand giant that's transitioning its identity? Or has the core Celsius brand permanently lost its momentum? It's literally the multi-billion-dollar question, and only the next few quarters will give us the answer. Thank you so much for joining me for this explainer. Keep learning, and I'll catch you in the next one.